Hello, this is Daniel Homlin for the Alternative Investing Club show. This is a show which brings to you conversations with private operators and real estate investors. And today we have a person that is going to talk to us about shopping centers and investing in shopping centers in secondary and tertiary markets. Andy Weiner, good to meet you. Welcome to the
Hey,
show.
Daniel, thank you very much for having me on the show.
Excellent. So, really quickly, these conversations, just to let people know, the Alternative Investing Club show is a shorter version of what we do on Fridays at noon. This particular one is just to let us get to know Andy and to introduce him to our particular investor club and to anybody who might be out there listening on social media. So, Andy, could you introduce yourself in 90 seconds or less, and then we'll start digging into your company strategy.
I can do it. Great. Thank you, Daniel. So, my company name is Rockstep Capital. We are based in Houston, Texas. That's where I am right now. We have been investing in shopping centers for 28 years. We currently own 22 shopping centers in 11 states, and we have built or acquired close to 10 million square feet of shopping centers. Before that, I ran operations for a chain of 159 clothing stores. So I grew up in the retail business. And then my understanding of retail and shopping centers led me to start my own company. We target secondary and tertiary market open air and enclosed mall shopping centers. We target to our investors an 18% plus IRR over a 5-year hold, a 5 or 6 year hold, basically a 2x, doubling of your investment. And we do that in the shopping center sector where there's a lot of cash. So we pay a 8% to 9% preferred return depending upon the level of investment. And our properties have cash flow day one.
Okay, so great introduction there. And tell me a little bit about your motivation. What got you into shopping centers, and why shopping centers other than some other asset class?
Yeah. So, Daniel, I grew up in retail. I love retail. Retail is about stores. I understand the Amazon effect. I understand how stores operate, store metrics, store profitability. I look at retailers. I understand who's got winning strategies, who's got challenge strategies. And then real estate is just a great place to invest. I think everybody should have 10 to 30% of their investable net worth in alternative investments like real estate. And as you move up higher in terms of your net worth, you'll see that percentage actually go higher.
Mm-hmm. Mm-hmm. Okay. So you were in this from a young age. You, like you said, you kind of grew up in it. I think you mentioned to me your parents were in this too. Is that
My
correct?
grandfather
Your grandfather.
started this company in Houston in the 20s,
Okay.
1920s, and he started out with one store. During the Depression, he went bankrupt
Mm-hmm.
and wasn't required to pay back his creditors, but he felt morally obligated to pay them all back. And he couldn't find two of his creditors. He hired a detective and he found the final two creditors and paid them all back. And that kind of honor is something that resonates deeply with myself. Do the right thing, do the right thing always. It's one of our rock steps. And I certainly will mention rock steps later on in this.
Let's talk about it right now because that is a great way to start a conversation with a new operator, and that is to get to know a little bit about your philosophy because things like a rock step are exactly what keep us all moving at the same time within a company and keep us on the same wavelength. So why don't you go ahead
Sure.
and talk to people about rock step?
So let me start with the word rock step, Daniel. So it is not a word in the dictionary, but dancers know what a rock step is. It's a dance move. So I mentioned to you previously, I love big band music, 1950s, 1960s genre of Frank Sinatra, Peggy Lee, Ella Fitzgerald, Sammy Davis Jr., Rosemary Clooney. This might be before your time, Daniel. Okay.
My wife
Any,
actually plays the same music, so
okay. So
she
big band music. When you swing dance, couples dance, ballroom dance, you rock step when you switch direction. And on an 8 counts, it's 1, 2, 3, 1, 2, 3, rock step. Ball pivot change. Your dance teacher might have used that term instead of a rock step, but rock step is a word dancers know. So we use it as a metaphor. Guys, we've got to be nimble. We've got to be light on our feet. We've got to listen to the music in the industry, and the music is always changing. And if there's a problem, we've got to respond. We've got to rock step. We've got to change direction. If there's an opportunity, we've got to rock step and go at it. And so we use it as a verb in our company. Everybody in the company knows the word rock step. Hey, guys, we got an opportunity. We got to rock step. Or, hey, guys, we got a problem. We got to rock step. We got to be nimble. We got to change directions. And then second, Daniel, I wrote a guidebook for our company, an owner's manual of rules of behavior that are very specific rules. There's 25 rules. And these rules are called, as you know, rock steps. Mm-hmm. And these are in this little book. It's on my website, rockstep.com. But I am crazy, nuts, to the mat, emotional about these rock steps. And when we hire people, we hire them based upon these rules. What are your favorite rock steps and why? What are your most challenging rock steps and why? And we have a rock step of the week. We are on rock step number 11. Get clear on expectations. So the whole company, we have 75 employees, Monday at 10 o'clock, gets on a call, and we talk about what does it mean to get clear on expectations. And randomly, the person who wrote an essay the weekend before calls on 3 people. Susan, what does it mean for you to get clear on expectations in your personal life and in your professional life? And we have that conversation. It's how we hire people. It's how we fire people. We are required to live by these rules. We're not perfect. We're required to live by these rules between us, with our investors, with our lenders, with our communities, with our tenants. And so that's the question. What are my favorite 3 and why? What are my most challenging 3 and why? You want me to do it?
Yeah, let's do it.
Okay. My favorite 3 and why. Rock step number 1, do the right thing always. We're Indian.
And then after this, ask me one of them too. I want to join in.
Oh, do you have a favorite?
No. Ask me, read one of them and then ask me what it means to me, or however you would quiz somebody. I have not read over them yet.
Got it. I'll do that. So do the right thing always. Rock step number 1. We're in the investment business. The investment business is the world of gray. It's the world of gray. So you always have to say, okay, what's the right thing to do with regard to this issue? You have to have that conversation. You have to use that vocabulary. Number 2, rock step number 3 is be punctual. On time is late, and 5 minutes early is on time. Okay.
I like that one.
My son wanted us, when we go out for dinner, everybody get in the car, then I'll turn off my video games. Okay. Drive me nuts. Okay. And then rock step 24.
You're not the only person to have that problem.
Okay. Keep family first. If you don't take care of your health, if you don't take care of your family first, you can't take care of rock step. Those are my favorite 3. My most challenging 3 are rock step number 4, be a fanatic about response time. I struggle keeping up with my emails. I just struggle with it. Number 7, listen generously. As my wife will tell you, it's not my greatest strength. I'm impatient. Oftentimes I'll think about what I'm saying. I want to say when somebody's talking. It's a very, very bad habit. And it is a forever work in progress. And then rock step 25, keep things fun. As my wife says, Andy, you take the fun out of fun. Okay. So I'm very happy on the inside, Daniel, but I'm pretty serious on the outside. My wife is very cheery and smiley and happy on the outside. She's a wreck, a nervous wreck on the inside. Okay. So anyway, those are my favorite 3, my most challenging 3. And you want me to ask you, your favorite, or do you want me
Well,
to?
I haven't read all of them yet, and frankly, I will because I love the idea. But I don't know. Is there, you mentioned in your meetings, you read the step of the week and then ask somebody what that means to them.
Okay, so
I'm willing
let's
to at
let's
least
go to rock
listen.
step number 8. Speak
Okay.
straight, and I'm going to read it out loud. Speak honestly in a way that helps to make progress. Say what you mean, and be willing to ask questions, share ideas, or raise issues that may cause conflict when it's necessary for team success. Be courageous enough to say what needs to be said. Address issues directly with those who are involved or affected. So, Daniel, what does that mean to you, either in your personal life or in your business life?
That's an interesting question. I'm gonna have to think about that for just one moment. But what I will say immediately is that I've always been a fairly plain-spoken person.
Yeah, I can tell.
Um, I mean, for one thing, I truly dislike people that are just duplicitous or people that hold things back. It's perhaps a pet peeve, but honesty is the best policy. I like where you went with bring up conflict where it is necessary,
Yes.
because honestly, by nature, I might tend to be a little more conflict adverse, and I think I've grown out of a lot of that, to be
Yeah.
honest.
And
And my wife is the same way, and when the two of us, or neither of us, are addressing something that needs to be addressed, you can feel a buildup of tension. We in fact have, my wife started this tradition, two little wooden ducks sitting on our fireplace. And it's a South Korean tradition. If
wow.
the wooden ducks are facing towards each other, everything's good. But if one of them is turned away, oh, there's an issue that needs to be addressed. And so we it started off actually kind of as a joke, but it's turned into something we reference a lot when something needs to be brought up. I think with our investors, being quick and responsive is not only the best way; it's the only way that it should be done. Um, you should, frankly, be an open book to the largest extent possible.
Yes.
Um,
And if there's bad
I'm
news, you've
almost a
got to
little fanatical on that.
yeah. If there's bad news, you've got to share it. And
Absolutely.
in bad there is at times to time there's bad news in life.
Yeah.
Okay, that's what happens. Okay,
Yeah.
so that's the kind of exactly this kind of conversation, Daniel, that we have as a company, and we do this 25 weeks in a row, and then we start again. We've been doing it for 8 years, and you get used to that conversation. Hey, I want to speak straight with you. Jody, keep family first. Your son is an issue. Take a week or two off. Keep family first, and then you know what? Hey guys, we got to do the right thing here. Or be punctual. Steve, you've got to be on time to these meetings. You got to be relentless and respectful. Okay.
Hmm.
And if somebody is not keeping up with the rock steps, you've got to get them to keep up with the rock steps. And if it becomes a serious issue, you've got to cut bait.
Yeah.
So
I
anyway,
like I love
we,
this.
we
I'm
use it.
definitely reading through these.
We're fierce about this, Daniel, and the goal is to have a very very high performance team. Okay, so we're Rockstep 22. Don't be a jerk. We do not allow jerks, and very frankly, we don't allow brilliant jerks.
Yeah.
Okay, I've made a mistake in the past. I had brilliant jerks in the company.
Yeah.
Okay, don't do it. Okay, and so it's the language we use, and it it makes things better. And we've attracted people from Blackstone and Brookfield and CBL, some of the big REITs in our space, who like to be part of a team that lives by rules that build up people and build performance instead of bringing down people. Okay, that's what we do. So I might have spent a little too much time on that, but I will tell you it's more important than any deal we do.
Well,
Okay.
let's connect it back then.
Okay.
How, obviously, this is team building, this is cohesion, this is being all on the same page. How does it directly affect your performance? And is it a holistic performance where just it's affecting the entire performance of your team, or does it really cut to a specific, action on a particular day, a particular deal?
Look, it's a great question. In other words, how do these rules affect the performance of the company on an asset and affect the performance of the team?
Mm-hmm.
The answer is it is an intrinsic part of our success, but it's not the only part. Okay.
Mm-hmm.
So I didn't mention this to you when we talked earlier, but we're also an adherent to a business operating strategy called EOS. Are you familiar with EOS?
I'm not.
Okay. The Entrepreneurial Operating System. So it is a business operating strategy that's very codified to continually have everybody in your company set quarterly goals, measure weekly against those goals to drive the most important impact in their particular goal, measure every week against these goals, set challenging goals, and to do it in a very structured way. And about 40,000 companies around the world use this as an operating system. Okay. It's called EOS, the Entrepreneurial Operating System. And it is really, really good at moving forward what is called traction and performance. I'm talking the day-to-day operations.
Mm-hmm.
Okay. So
Sounds,
again, what's that?
I was going to say, it sounds similar. As people know here, a software developer by trade, and I worked at Intel for 12 years, but it sounds very similar to Andy Grove's philosophy of OKRs. And he wrote a book called Measure What Matters. And it at least from what you just described there, the two philosophies sound very similar. There's probably differences.
So look, we are an operating business. It has operating strategy and it has people. And we've got to be A+ in both. You got to be A+ in the people side, in the culture, in the behaviors, and then you actually have to operate A+, okay, in terms of the assets and the leasing and the property management and the reporting and the acquisition and the underwriting and the construction. All the pieces have got to be done at an A+ level. Team and operations. That's what we do.
All right, let's talk about the assets then.
Sure.
What type of assets do you typically target? What are the characteristics that you look for?
So we are shopping center investors, and we invest in secondary and tertiary markets around the country. Two types of shopping centers is our focus. Open air. Open air is something like a TJ Maxx and a Ross and a Best Buy. Some people call them large neighborhood centers. Other people call them power centers. This was call them open air. Okay. The second are enclosed malls. And enclosed malls is more of an opportunistic strategy because there's $50 billion of insolvent debt under extremely well-located properties. Okay, malls are well-located, but the architecture in many cases is outdated. And you can buy these at cap rates. The enclosed mall space, you can buy them at cap rates about 15 cap, unlevered. Okay, extremely high cash flow. You can buy open air centers in secondary markets with great credit at about 9 cap. So the advantage you have in today's world for shopping centers is that Amazon and COVID, Amazon in particular, but COVID just accelerated it, basically destroyed a lot of the players that couldn't compete. But those that are left have their own e-commerce strategy that's very effective. They can not only protect market share, but they can grab market share. And they have great balance sheets, TJ Maxx, for example, and they want to grow dramatically. So they want 100 stores a year, 200 stores a year. But different than multifamily, different than industrial, there's no new shopping centers. No one's building. So all these companies are expanding into an inventory that's not growing. So if you own an existing shopping center, you have a great investment. If you own an open air center at 70 or 80% of replacement costs, it's a good deal. If you own an enclosed mall at 10 or 20% of replacement cost, That's a great deal. Okay. And we'll talk about that in a second.
I-
The second advantage of the shopping center sector compared to where everybody's been putting money in multifamily and industrial, multifamily is the big one, is that we have positive leverage. What that means is that your cap rate is higher than your interest rate.
Yeah.
So that by adding debt, you're enhancing the value to the investors. In multifamily, you could have a multifamily in California on the West Coast that's valued at a 5 cap, but your interest rate's 6 or 6.25.
That's common in
So,
probably half the country.
So there, your strategy is what is called a strategy of prayer. You pray that very, very quickly in that multifamily asset, you can increase NOI so quickly that you're going to get out of negative leverage. We don't like prayer as a strategy, not in the real estate business. Okay. So in the enclosed mall space, you're buying something at a 15 cap, you're borrowing at 7.5 cap. So your cash on cash return is 20%. In the open air space, you're buying something at a 9 cap, borrowing it at 7.25. Again, positive leverage. Leverage enhances the return. The other thing that we do, Daniel, is that when we buy an enclosed mall, we require, and we're the only ones in the country to do this, we require that part of the equity comes from local business leaders in that community. And we're the only ones in the country to do that. So we go and we say, okay, in Hot Springs, Arkansas, we like this asset, great community. It's got all the essential drivers that we think are important in a secondary, tertiary market, whether it's tourism, whether it's military, whether it's Fortune 1000 companies, great hospital district, major university. It's got to have something or multiple of those things. But in addition, we've got to have some of the business leaders put equity alongside my own equity and our other investor equity. That helps for incentives. We're great at getting incentives, entitlements, property taxes, relations with City Hall. Oftentimes our investors are deputized leasing agents because they are on the board of the community college or the hospital district or the economic development.
How do you go about locating those individuals?
That's what we do. Daniel,
Okay.
That's what we do. So it's a networking. We talk to the economic development. We talk to bankers. We talk to presidents of banks. We talk to community leaders who, we're looking for people who like to invest in real estate and who want to invest in their community with somebody who's got expertise and can bring outside capital.
I like that. I like finding the local people to help
Yes.
you invest in their own communities. That is actually one of the major themes of the Alternative Investing Club is, invest on Main Street, send the money to your community, not to Wall Street.
So I'll give you some examples. New Orleans, we bought the Riverwalk from the Howard Hughes Corporation. We bought it with a group of 7 New Orleans investors, some of whom probably the business leaders of New Orleans. We ended up getting a $1.5 million annual annuity. It's redundant. An annuity, unbudgeted, because our investors knew City Hall, knew the mayor, knew City Council, and without my involvement, got it done.
Nice.
If I was just by myself, I would not have been able to get it done.
Yeah.
In the Midwest, we are working on a development to bring in a major retailer, and we're asking a community for $16 million of incentives. So one of our investors set up a meeting with the mayor on Friday, and then we have 7 investors again from that market. 3 investors are going to follow up that meeting after this initial meeting, and then we're going to work at changing the law in that state, and we will be successful to get a $16 million unbudgeted incentive. Everybody's aligned. We are aligned with local investors. And second, I didn't mention this, we're really, really good at getting low-cost community bank debt. And oftentimes, our local investors are on the board of our local lenders. And community bank debt is the most flexible, lowest cost debt there is in commercial real estate for these type of assets. So it's all about local investors, local lender. We're vertically integrated. We've got 75 employees who have who live by these rock steps, who are really, they've got great institutional training coming from other companies. We are focused on these assets from a community perspective, and we have never given a property back to a lender. We've never had a capital call beside the opening capital call when we bought the property. And if you look at Simon and Brookfield and Macerich and CBL and Preet, they've lost dozens of properties, and we've never lost a property. Okay.
So you mentioned earlier that you're across 11 states, and
Yes.
yet you're so hyper local. Do your employees all go to work where you do, or are they distributed
Out of the
across these 11
75,
states?
15 are in our Houston office.
Gotcha.
Our directors of mall management, Jody lives in northern Minnesota. Renee lives in western Mississippi. Our 3 directors of leasing, Racine lives in St. Louis. Brandy lives in Dallas. Casey lives in Dallas. Our chief investment officer, Dimitri, former Brookfield guy, lives in Chicago. And we've got property people around the country. So we were remote before COVID.
So for our investors that are just learning about you for the first time, how often do you acquire properties, and how often are you looking for investors to put capital in?
Yeah. So we are switching a little bit, Daniel, our business model, a lot actually. We used to do only syndications, okay, which means you found an asset, you stop everything you're doing, you raise $5 or $10 or $15 million. What we have found is the lenders who oftentimes are selling properties that are insolvent are requiring that buyers have committed capital in order to win the deal. So our Hometown America Fund is our vehicle for committed capital. And what we will do is the fund will invest in each deal. There also is co-investment opportunity at the deal level, particularly for local investors. Okay. But also some people don't like funds. The advantage of a fund is diversification. The way our fund works is it's a $100,000 minimum. And if you get with an 8 pref, should be current. If you get to $1 million, it's an 8.5 pref. If you get to 5 million, it's a 9 pref. And the split gets better as you hit each of these tiers. So the split means after investors get their preferred return and all of their capital back, if you're under $1 million, the split is 70-30, investors sponsor, and then it goes to 75-25 at $1 million and 80-20 at 5 million. So obviously larger check writers get a slightly better return. You'll get 5 to 7 properties. We're targeting a 2x and 18% IRR over a 5 or 6 year hold.
Okay.
That's kind of the basics.
I think that I've got a pretty good idea of your business, or at least an introduction to it.
Okay.
I'm looking forward to, going through and doing my own research and reading through I'd love to read through your fund documents.
Did I send you the deck already? I thought I did, but if not, I will. Okay. I will send you the deck, and anybody who goes to rockstep.com, Daniel.
Yeah, that's right. I have it.
Okay. Can pick up the deck. All they have to do is fill out their email, and you have access to the deck. So that deck is a 60-page story of our team, our strategy, some of our properties where we have redeveloped properties. It's got it all there.
All right. And the very last question that I always ask every guest here is the surprise question. Can you recommend a book to us? It doesn't have to be an investing book. It doesn't have to be a rock step. But just a book that will...
I will do 2 books. I love history. Okay. And then I'm going to give you one business book and one history book. I think history I'll start with. I'm in a history book club. Anything by Roger Crowley. Okay.
Roger Crowley.
Roger Crowley wrote 1453, The History of Constantinople. He wrote a book on Venice. He wrote a book on the conquistadors. And he is a professor either at Cambridge or Oxford that writes amazingly good histories from that period, page turners. Second, there is a business book called The Road Less Stupid by Keith Cunningham that talks about how to think about life and business and how to avoid mistakes and the importance of avoiding mistakes and also having thinking time. And I've read, I don't know, 100, 200, 300 business books. It's my number one.
Got it. Got both of those. Great books. I hadn't heard of either of them. Andy, thank you so much for being on the Alternative Investing Club show. Our members are going to see this video as well as people that are out there on the social medias. We look forward to having you on one of our future upcoming Friday meetings every single Friday at noon Pacific
Can't wait,
time.
Daniel. Thank you. And I appreciate the time.
All right.